Good afternoon. It's Patrick Tour and Greg Poole. And backed by popular demand, we're going to be talking a little bit more in depth about the cost of moving to Florida. So let's jump right in here. You're sitting at your desk in New York. It's in February. It's 12 degrees out. You just opened your tax return and you realize you just wrote a check to New York and New York City. It was larger than your mortgage used to be. And you think, why am I still here? Why am I still here?
That tends to be the moments, right, where the conversation we have with clients now more than almost anything else right now. And, I think Florida isn't just a retirement destination anymore. It's a financial decision, and it's a really serious one.
Yeah, I mean, so we're going to walk you through the whole picture. What does it actually cost to live here, to live the life you're imagining out here? Because it's not cheap. And let's be honest about that. What you actually save by leaving a high-tax state like New York or California, what it means for your kids and grandkids, because we're going to work them into your financial plan here, just so you don't forget that's part of it as well. And then this is the part people get wrong, how you actually establish Florida residency in a way that upholds, and we're going to use New York as the example here. We're going to and some basic things in case they come looking for you and what they will come looking for.
And they will come looking. We're going to use a very specific scenario through this. It's a married couple, 60 years old, 3 adult children. They're done working or nearly done, and they've had a paid off home in New York. They want to keep as a family base, and they want to do Florida right, not just, buy a condo, but actually live here. Primary residence, homestead, the real thing.
Right. And so we really did 2 scenarios, a Naples golf community lifestyle on one end and Miami or Palm Beach waterfront on the other. And we'll kind of walk through the numbers. So we're trying to show like a high and low of luxury life, sort of like what does it really cost? Like to do, the basic stuff that people want to do, like put it all together. So we'll call this the Florida lifestyle, the free markets, Naples, Miami, Palm Beach, and that's where we're going to walk through.
Yeah, because it's not all one place. And Florida can be different things, different folks. It's high net worth family look completely different depending on where you live.
That's right. And everything we're describing here, you could do in South Carolina for about an eighth of what we're going to discuss. So Naples is the golf capital of the world. They have over 70 private courses, quieter, elegant. It's for a couple who wants to be on the course by 7:30, finished by noon, and sitting on the lanai with a cold drink, Mediterranean, Quail West, Gray Oaks. These are really popular places. They are spectacular communities, owns in the $48 million range for a serious property.
Miami, completely different animal. It's a global energy, high energy city. Restaurant scene, art, finance, Goldman, Citadel, hedge funds at Bluefield, Connecticut. You've got North Bay Road, Venetian Islands, Key Biscayne, waterfront properties starting around 10 million going up. We saw waterfront sale in 2025 get over $90 million. So the ceiling in Miami is very high.
Yeah, and Palm Beach is its own category. That's old money. I'm not allowed to go there. New money and serious social energy. The island itself, just over a mile wide, has a median sale price north of $9 million now. That's 118, upper 180%, 118% in 5 years, 180% in 5 years. Town is physically very, very small. Everyone knows everybody. Stephen Ross, who from Blade Group is bringing tens of billions to downtown West Palm. So it's totally transforming into like another real big city.
So it's, I think the other thing to understand about what we're going to walk through today, and it's important for everything that follows, we're not talking about replacing your New York life. We're talking about adding Florida, but making it your primary residence while keeping your New York property and making that a secondary property. So that's the scenario that we're running, and we want to look at how the math, changes.
Yeah, and this is really like a conversation that we have a lot with really wealthy families. So you're going to be carrying 2 properties, 2 sets of taxes, 2 sets of insurance, 2 sets of people taking care of your properties. And the question isn't just what does Florida cost? What does the 2 homes, the full lifestyle really cost? And then does the tax savings, how does that kick in? How does that help? So let's do the numbers and give you guys some ranges in each place that are really quite detailed and realistic.
So let's kick off the segment of what it actually costs, the full 2-home picture. Let's start in New York, because this is the cost I think that surprises most people. Your New York home, it might be paid off and you might think it's free to hold, but that's not the case. Not even close.
Yeah. And so we're assuming a Westchester home or some comparative with like $5 million plus house value purchased years ago, You got property taxes, which in Westchester can run 55 to 90,000 bucks a year on property. You got insurance, you got to maintain it, your housekeeper, caretaker. You have a country club dues, and you still got automobiles up there. When you add it all up, you're likely to spend, hundreds of thousands of dollars. For a couple $100,000 to $350,000 a year is bad coin.
Now that's before you set foot in Florida, right? So let's add Florida now. So, the single biggest variable in Florida's cost, especially at the high end, ends up being insurance, not taxes, but actually insurance. And windstorm coverage on waterfront home in Miami can run $150,000 to $350,000 a year. That number, shocks people until they see it. Quote you.
The good news on taxes, and this is generally good news, is that Florida's homestead exemption combined with Save Our Homes cap is now a real benefit over time. You get $50,000 exemption off assessed value in first year. More importantly, starting the year after that, you're capped basically to like a 3% increase per year. So that keeps your, that cost doesn't skyrocket.
So, in a Naples home that's, let's say, $4 to $5 million, you're looking at property taxes around $35,000, $5,000 a year. Collier County is one of the lower rates in the state. Big add insurance, HOA fees, club dues, maintenance, utility staff. The Naples home costs around $200,000 to $300,000 a year to carry.
Yeah, Miami or Palm Beach waterfront picture is different. Taxes on a $12 million Miami home might be $160,000 to $260,000 range after homestead. And again, the insurance number is substantial. So total cost to carry high-end Florida home, $500,000 to $1 million a year on a really big property.
And then you've got kind of the lifestyle expenses. So, travel, dining, healthcare, assuming the couple is 60, pre-Medicare. So health insurance is a real cost, $30,000 to $60,000 a year until 65. Personal expenses, charitable giving, and then helping out be it built kids. That's done a video on. But when you add that all up, lifestyle expenses can run, $215,000 up to $1 million, depending on how you want to.
Yeah. So we talked about, just a little chart here, kind of on the low end. Naples will cost you $193,000 to the high end, $335,000 in Miami. Florida primary homestead to $106,000 to $820,000 in Miami Palm Beach. So really pretty significant numbers to live life. And then when you get into lifestyle and so forth, that can range $215,000 a year. Travel, dining, $1 million. Total after-tax spend ranges from $600,000 to $2.1 million. Gross income you need to pull this off, high and low, and is $800,000 to $3.1 million a year. So a lot of money. And if you're just looking at what kind of investable assets you need to support something like that, anywhere depending on obviously rate of returns, but more conservative rate of returns, you need somewhere between the $35 million and $110 million net worth on the very high end and the low end to support these expenses, plus to carry your property up north. We're factoring in that you have children and that you're going to do some things for your kids. So we're really trying to show you what kind of net worth is, what's an appropriate amount, what you can spend, the end for net worth.
So to sum it up in a simple version, if you're doing of these three, the lower end 2-home Florida retirement, Naples, which is comfortable, not flashy, costs about $615,000 a year of spending. So to generate that after-tax income at a sustainable 3.5%, which are all right, you need about $23 million in investable assets. And so you add the homes in, you're at a $35 million net worth target that would be required.
Yeah, it's big. And the high end Miami or Palm Beach waterfront, the cost of a $2.2 million, cost about $2.2 million a year, you need roughly $89 million in investable assets. It's a lot. Total net worth around $110 million.
Yeah, so these are big numbers. So now let's talk about the other side of the ledger. Let's talk about what you're saving. Let's go through the math. This is the number that changes people's minds. So New York State's income tax at the highest bracket is 10.9%, and then the city adds another 3.8% on top of that. So combined effective rate for our clients, in this range, somewhere between 12 and 14.5%, depending on the income level. That compared to Florida state tax, which is much simpler, 0.
Right. I like 0. 0 is very, very good. That's the whole number is 0. So the question is that what does that actually translate to in real dollars? Like what does this mean? And by the way, there's also capital gains taxes and everything else up there as well. So let's take a look at this chart right here, and you could we'll talk about this chart now. Right?
Yeah. So, I mean, you can see this at the low end of the scenario. The couple needs about $800,000 a year in gross income. They're saving somewhere around $108,000 a year just by being Florida residents instead of New York residents. And that's an annual number, and that goes on, forever.
Yeah, at the high end, needing about 3.1 million in gross income, the annual savings are closer to $400,000 or $500,000 a year to be in Florida. And over 20 years, the cumulative number is over $9 million just on income alone. So it's a real number. It's a big number. I mean, it's a big number.
And that's even before you're adding in capital gains.
Right. Yeah, this is one that matters the most for executives and business owners. Right. New York treats long-term capital gains as ordinary income. There's no preferential rate. So if you sell a concentrated stock position, if you have liquidity event, if RSUs vest and you sell, New York takes 14% or more. Florida takes 0.
Yeah. So think about what that means for a client who's selling a $5 million block of appreciated stock. I mean, if you sue New York resident, that sale might cost them $735,000 in state and city tax, depending on the file case, but that's a big number. As a Florida resident, it costs them nothing in the state law. So that's just a single transaction.
Honestly, for clients who are doing tax loss harvesting, we do tax loss harvesting of long short extensions to create tax losses to kind of to push those tax bills down, which is exactly what we do here. There's an additional layer, but every time you're harvesting losses and reinvesting, the tax savings compounds more efficiently in a zero tax environment. And it does. So the math is just much better in Florida.
Yeah. So, I mean, let's put it in terms of the New York home. On the low end, the family saves about $108,000 a year in state taxes. Their New York home costs about $190,000 a year to carry. So the tax savings, covers more than half of the New York home. The Florida move is essentially subsidizing their decision to keep the New York place.
Yeah, and so at the high end of this range, $450,000 annual savings more than covers the entire New York home carrying cost every year. So the Florida lifestyle doesn't just pay for itself, it pays for New York too. So that's really very, very compelling so the wealthier you are, kind of the more the math actually makes sense.
Yeah. Let's talk a little bit about the generational picture. So kids, grandkids, maybe Pat, walk us through the kind of full picture.
Yeah. So now let's talk about the full picture because the couple isn't just planning their own retirement. If you have a lot of money and you have 3 adult kids, and we assume that you're going to have 8 grandchildren, we're really optimistic about grandchildren. And at that level, you're not just spectators in those kids and grandchildren's financial lives. I mean, you're the family bank, right?
Yeah. So there's 3 things we're accounting for in this. We're doing 3 weddings over the next 5 to 10 years, 3 home down payments, $1 million per child, which is in these markets, the kids are likely buying, isn't a crazy house. It's functional for what they need. And eventually 8 grandchildren going to college. So all of this we're assuming is it's real money, and it has to come from somewhere to fund.
Yeah. So the college number is the one that surprises people the most. And by the way, maybe college isn't like this in 20 years. It's maybe, who knows what's going to happen, but we got to put in what reality of today. A 4-year private university education costs roughly $400,000 to $500,000 all in today. Tuition, room, board, fees. College costs have inflated about 4% a year historically. So by the time your grandchildren are born, each college age is 18, the bill could be several $100,000 to $1 million per child. So 8 grandchildren, you're looking at maybe $8 billion in the future. So a lot of money, a big chunk of your net worth is going to go towards educating these grandkids.
It's a lot. Yeah. But that's our recommendation for families in this situation is not to try to fund that through annual income. It's to set aside effectively a capital reserve today. Somewhere between $6.5 and $8.5 million as a dedicated investment account, and then let it grow. We think we can create something and let it grow 5 to 6%. The weddings and down payments will come first over the next 5 years, and the education follows them, over the next 15 to 25 years.
Yeah, there's also, like in Florida, 529s are here too. 529 strategies we think are just the best. They're so simple. Federal allows what's called super funding, so you can put 5 years of your annual gift exclusion into a 529 all at once. As a couple, that's up to 180,000 per grandchild. So your grandchild is born, you give them 180 grand, goes into this tax-free account. There's no 1099, there's no taxes to pay. You could be the trustee, and that grows for the child tax-free. And when it comes out, it could be used for private school, private college, could even, be used for other things too. You'll just pay tax on it. But it's a great, simple vehicle to use.
Yeah. And then, the lifetime gift tax exemption is also something the couple needs to act on, Etsy, in the near term. I mean, the $3 million in home down payments for the kids is a fraction of that, but the exemption is scheduled to sunset. It could be cut in half if Congress acts. So if you're going to make large gifts, the window to do that at the current exemption may be limited. So that's something that we think is worth thinking about and structuring today.
Yeah. And really what we're trying to do here is give a range or a picture of, if you're a wealthy person, if you want to live a really nice lifestyle on the low and take care of your family, because people always come to us and I want to live, but then they also talk about their kids. We're talking about somewhere between 42 million and 120 million, depending on, how big of a lifestyle you want to live to fund all these things.
Yeah. So I guess start us off how to actually leave New York and make it stay.
Yeah, this is the most important thing. And obviously, every state is a little bit different. We're very familiar with all these nuances in our job. But here's the thing, nobody tells you when you decide to leave Florida. New York does not care that you think you moved. They don't care, right? New York has a dedicated non-resident audit unit. These are very unpleasant people. At the income levels, we're talking about hundreds of thousands to millions in state tax savings. A domicile change to a zero tax state will almost always trigger a review. Not might, almost always. So you really have to plan for this.
Yeah, and then the auditors, the New York auditors are good at their job. They've been doing this for decades. They know every mistake. They pull credit card records, phone logs. They look at timestamp locations, easy pass, transponder logs, phone carrier data, building key, fob access logs, social media posts, club sign-in books. They are systematic and thorough.
Club sign-in books is the craziest. That's just unbelievable. So the goal isn't to move to Florida. The goal is to build a documented record of your Florida life that is so clear and so complete that when the audit letter arrives, potentially 3 to 5 years after you move, your file tells a completely different story. It says, we're covered.
Yeah. So let's start maybe with the legal standards. So New York uses a 2-part test. To owe New York income tax as a so-called, statutory resident, you have to satisfy both prongs. First, maintain a permanent place of abode in New York for substantially all of the year. And second, spend more than 183 days in New York during the tax year.
Yeah. And here's the trap for our scenario. You're keeping a paid off New York home. This means you almost certainly satisfy prong 1 automatically. For every year forever, which means the entire fight, if there is one, comes about the day count. And a day count in New York means any day you're present in New York at any point, even if you arrive late at night or early the next morning, counts as a full day.
Yeah, that's the key point.
Right. So your travel day, the day you leave and the day you come back, is a full day.
So if you step out of JFK and get in a car and then, leave the Westchester House, that's a New York day. If you stop in the city for dinner, that's a New York City day. So it accumulates fast, especially for families that keep a home there.
Yeah. But here's what makes New York particularly dangerous for sophisticated taxpayers who think they've managed the day count. There's a second test called the domicile test. Let me say that again, the domicile test. Even if you're 183 days, New York can argue that you're still a New York domicile, meaning your true home, the center of your life is still New York. And they use 5 factors to determine whether New York is really the place you live.
Yeah. So factor 1 would be the homes. So they compare your New York homes and your Florida home. Which one is bigger? Which one is nicer? Which one is better furniture? Which has better art, more personal touches? If your New York home is clearly the nicer of the two, and for people who've lived in their New York homes for 20 years and just bought a Florida home, that's actually a real risk.
Yeah, that's why we showed you, by the way, really beautiful Florida homes. because this is actually buying an expensive home is actually a good fact, right? Sure. Factor number 2 is your business connections. Where are your board memberships? Where your professional mail go? Does your professional mail go to New York or does it come to Miami? If you're still running a business or sitting on boards, all the activity is in New York. That's not going to be great for you.
Factor 3, time. We've talked about this, but how much time you spend in each place. The day count actually matters.
Yeah, factor four, and this one surprises people. It's your stuff, your near and dear items. So, where are your most valued personal possessions, your family heirlooms, your fine jewelry, your best art, your most sentimental items. If those are still in New York, because that's where they've always been, then that's not really your house.
That's right. So I mean, look, there's real case precedent here that surprises people. So New York auditors successfully argued, that taxpayer who physically spent less than 183 days in New York was still a New York domicile because the quality of their New York life and the substance of it, their doctor, their church, their closest friends, their most valued possessions were all in New York, which outweighed the Florida connections that was clearly secondary despite the number of days.
It's almost comical, but factor five is family and social ties. It's actually like financially beneficial for you to have more friends in Florida. So just go well. I mean, where does your spouse primarily spend time? If your wife spends all her time back at home, you're in trouble. Where, if she doesn't really want to make the move. Where do your grandchildren go to school if they're young? Where do you worship? Where do you socialize? Where are your closest friends? Who do you get back to in the community? So if you're still writing checks, to Mount Kisco Hospital in Scarsdale, where I was born, and you live in Naples, that's not a good factor.
Yeah. So let's walk through what you actually have to do. We'll give you the full checklist, but let's start with, the absolute must-dos from the first week. What do you do on day one?
Day one, file a Florida Declaration of Domicile at your county courthouse. This is a formal legal document. It's not expensive. Take maybe 20 minutes. It creates a dated notarized public record of your declared intent. I live in Florida because remember, Florida doesn't really care. They're not taxing you, so they're not chasing you down. You just got to get it done. That's job number one.
So week one is get Florida driver's license and surrender your New York driver's license. You can't have both, and the Florida license is one of the clearest signals of intent and one of the first things that an auditor checks. So, update every bank account, brokerage account, financial institution to your Florida address immediately. Change your Amazon default address. Change your Apple ID address and every online retailer. A credit card change at a Florida pharmacy on a Florida address tells a small story, and in aggregate, all those small stories will add up.
Yeah, you got to register to vote. You cannot be registered to vote in 2 states anyway, so New York registration is treated as a formal declaration of residency. It's low-hanging fruit for auditors. You got to make sure you do that one. That's the easiest one to mess up.
And lastly, there's a double benefit because it has an economic benefit, but file your Florida homestead exemption by January 1st the following year. So this is a legal declaration filed with your county property appraiser, and it gives you the $50,000 tax exemption. It triggers the Save Our Homes cap, but it also creates a formal public record saying this is my primary home, and that's powerful documentation.
Yeah, and I would say now let's talk about a couple less obvious things your tax attorney might not think to tell you, but actually come up in real audits. Unfortunately, we've been involved in these. It's not pleasant. The dog test. Where does your dog or cat live?
Yeah.
And who is your vet? I mean, you're talking about that's just creepy. But the New York auditors have pulled veterinary records. Vet requires regular care. So it's an easy one. Vet appointments, grooming, like your groomer. Imagine them subpoenaing the groomer, but they'll do it. They're not, and if your pet's vet is in Manhattan, and it always has been, you need to change vets for your dog.
Yeah.
I mean, I know it's ridiculous.
Yeah. It's a well-documented case law. New York auditors know people go home for the holidays. So if your credit card records show you in New York for the holidays or Thanksgiving and Christmas and New Year's, even if you're there enough days, it tells them emotionally where you call home. So start spending your holidays in Florida with intention.
Yeah, this is a very well documented case law. New York auditors know that people instinctively go home for the holidays. So that's that impulse has got to change. If your credit card records show you're in New York every Thanksgiving and every Christmas, every New Year's and birthday, even if you're under 180 days and you've covered all the rest of the stuff, you're emotionally home. So spending your holidays in Florida, intentionally, that's
when it's a nice place to spend the winter holidays. So it's a double bonus.
Yes, it's also kind of why, as we did this, you really chose bigger properties to put, because if you're really going to drag all your family home, you're not on 2-bedroom condo.
Yeah.
Right. I mean, you can't be like, I'm a 2-bedroom condo in Florida and you have 10,000 square feet in Westchester. Right. That's not going to work.
So there's something we call the near and dear test. So move your most valuable possessions to Florida. So it's another factor formally evaluated in New York's domicile test. Courts have looked at where the taxpayers keep their wedding silver, keep their grandmother jewelry, their most cherished art. If these items migrate, these will migrate to where you actually live. So if everything of deep personal value stays in New York, because that's where it's always been, that Florida feels like a hotel room, the auditors will argue that that's a bad fact.
Yeah. I mean, you even need, as women, have their favorite hairstyles, and they don't go as, I mean, we go like haircut once a month. They go often. You actually need to prove that your hairdresser is in Florida. You cannot be getting your hair colored in New York. It sounds trivial, but these things reveal the truth. And if you've been doing the same person doing your hair for 15 years, you need to fire them on the Upper East Side, which is hard. And it's hard.
Well, Pack got his haircut across the street yesterday, so he's safe, which is good to know.
I never get my haircut the same place twice. I just walk into whatever's close by it. Anyway, but these are funny things. And then, of course, there's the safety deposit box.
Yeah. So, related to this, re-execute your will and estate planning documents under Florida law. It's a close, work with a estate planning attorney, draft a new will, new trust. These documents have jurisdiction, and when your will says state of Florida on it, that's another, piece of the record.
Yeah. I mean, they're going to geotag all of your social media posts. I don't even know what geotag means, but that's what they do. That's what we are geotagging, but you will be geotagged, which sounds kind of bad. This is a modern audit tool that people forget about. A New York investigation into your residency will include public reviewing of all your public media. It can be very embarrassing for you, Greg. You'll have to take down all those posts of your dog. Every time you tag a New York restaurant, check out most adults I don't tag restaurants, but if you're doing those kinds of goofy things, you need to stop doing.
Yeah. And then one I think that surprises people called the door hand problem. So one of the key reasons audits of city apartment owners are particularly detailed, and the buildings have records. So the key fobs, elevator logs, parking garage, package deliveries. If those records show you coming and going on days you claim to be elsewhere, the audit gets complicated, and the doorman will get subpoenaed, and they know when you come and go, and the building staffs are regularly interviewed in domicile like this.
And it's really like, I have Butterfly app for my apartment in New York and Upper East Side, and so they have a record. They just they know where everybody in the building is. That's really club memberships. Also an issue. You want to downgrade. People typically want to downgrade their New York clubs to out-of-state membership sort of thing. And in the Florida club, they have to be full member. They will look. It's not a paper exercise. They're going to literally subpoena the clubs. It's ridiculous to make sure that you're there. It must be hard to work, in all these service jobs where you're getting subpoenaed by New York all the time. It's poor hairdressers.
So, here's maybe the most important habit you can have. So if we call it the daily log, it could be a simple spreadsheet, one line per day, of city, reason why you're there. Is admissible evidence. You have apps like Tax Day or Moneo generate court-ready records with automatic location verification. Start this on day one. 3 years from now, when the audit letter arrives, this log will be the backbone of your defense.
Yeah. And, we can't emphasize enough. You got to do your audit logs, but it's easy with this technology now. The clients who win are the ones who keep their logs religiously, spend their target number of days in Florida, and move their life in ways that are visible and documented. They can do all this stuff and, and work with a good New York domicile attorney from the very, very beginning game. Bunches we can recommend for you, or California, or Boston, or wherever you live and you want to get out of. Like, you need to build a formal strategy to do it. Some advisors recommend spending 300 days outside New York across your first 2 years, roughly 194, 195 days outside of New York, just to be really, really clear. I think that's smart. Obviously, the best thing would be to fully exit the state, but most people have these spouses who don't want to do that. And so, that's just the reality of it. And but that's really what you need to do.
So let's take California for a second. So different rules, but same aggression. So, for anybody that's watching from California, the rules are different. California does not have a bright kind of line, the 183-day standard. They use a fact and circumstances test, meaning there's no magic day count that makes you safe. California will evaluate your whole situation, which we've actually just said New York can do as well. If they have a unique issue around equity comp. So if you had stock options, RSUs, carried interest that vested when you were in California as a resident, they may claim a portion of that income even after you leave, based on the fraction of the vesting portion you spent in state. So if you have a significant equity event ending, the timing of your move relative to that event it's a critical planning decision. Work with a California specific tax attorney before you file it.
Yeah, I mean, the general principle is just the same. You have to really move your life. I mean, that's really the bottom line, not just the address. But in California, even after a clean move, a long tail on equity compensation can follow you for years to come, which is just lovely. Just lovely.
But all this stuff that you're doing will put you in good stead. So let's close up. What's the aligned wealth perspective? So, moving to Florida, this level is one of the most financially significant decisions a family can make. If you're a couple that needs $3 million a year in gross income to sustain their lifestyle, the Florida move will save you $450,000 a year in income state taxes every year, plus capital gain savings on top of that. So it's a multi-million-dollar decision.
Yeah, but it has to be real. The families who do this successfully are the ones who actually move their lives, the doctors, the clubs, the prized possessions, their social energy. They're giving money to a hospital in Florida, not to one back at home. They commit to Florida. You got to commit. They document, they work with the right people. The families who fail are the ones who change the mailing address, show up in Naples and golf once a month, and really kept kind of fooling around in New York.
Yeah. So, but from the perspective here at Align, the tax component is one piece of a much larger planning conversation. Obviously, I mean, the low fees, the direct index, the broad diversification, those generate alpha, ideally tax alpha for sure every year, regardless of where you live. But then you layer in the Florida domicile decision on top of that, and you're compounding the tax efficiency across multiple dimensions simultaneously.
Yeah. I mean, we didn't really get into the estate tax in New York and those other things, but it's for your children. It's extremely powerful to you when your life ends to be in Florida. The net worth numbers we talked about today, 35 million at the low end and 110 million at the high end for retirement alone, or really high end retirement we're talking about here, 42 and 120 million when you factor in doing a lot of stuff for your kids. That's $1 million a piece for a house, paying for 8 grandchildren's college, and so forth. So that's kind of a realistic range for this stuff. If you're in that range and thinking about this move, or if you're working toward it, you understand what the target looks like. That's the conversation we have with families every week. And we'd love to have that conversation with you.
And if you're sitting on a concentrated stock position or a business you're thinking of selling, RSUs that are about to vest, the state you're sitting on when you hit the trigger is one of the most important financial decisions you can make. So don't let geography be an accident. Please, like something we talk about and deal with all the time. We'd love to have that conversation.
Yeah, we try to be humble in our investment approach, diversified and patient. That's how we invest. And when it comes to a Florida move, do it right, document everything, let the math work for you, and compound your wealth. Thank you so much for watching. I'm Greg and I. Please like and subscribe to our videos, and we look forward to talking to you. Take care.
All right.